Good morning, everyone, and welcome to this morning's virtual event, Post-Election Trade and Customs Implications, Preparing for Upcoming Changes. I'm Gemma Cortijo, the Executive Director of the Spain-U.S. Chamber of Commerce. Today's discussion will address the recent political developments in the United States, which are likely to bring changes. We don't know how significant yet. Certainly there will be changes to customs regulations. This event aims to provide you with three things mainly. First, proactive strategies for customs planning to mitigate the impact of potential new tariffs and duties. Second, key insights into challenges such as regulatory updates, enhanced supply chain monitoring, and rising import costs. And third, practical approaches to optimize savings and manage expenses efficiently. We are honored to have with us this morning two distinguished speakers from KPMG Trade and Customs. One of them is Araceli Beneyto, Senior Manager, and Irina Vaysfeld, Principal. Araceli Beneyto has extensive experience in both trade and customs and indirect taxes, specializing in areas such as VAT, excise tax, and custom reliefs. Her expertise includes advising clients on global trade operations, cross-border goods movement, and compliance strategies. Irina Vaysfeld brings over 16 years of experience in the import and export field. And before joining KPMG, Irina practiced as a customs and international trade attorney, bringing a deep understanding of regulatory frameworks and trade policies. Before we begin, a quick note on today's format. If you have any questions or comments during this session, please feel free to use the chat function and let me know that you have a question. And during the Q&A segment, I will call on participants in the order questions are received. So you'll be able to unmute to address Araceli and Irina directly. Please also note that today's event will be recorded, but only the presenter portions will be made available in a recording. The Q&A section will not be recorded. Again, the Q&A session will not be recorded to ensure an open discussion. Once again, thank you all for joining us. And without further delay, I'm pleased to hand the floor over to Araceli and Irina. Thank you.
Thank you, Emma. Thank you so much for the introduction. To add a little bit to that, both Irina and myself are in the New York office. We are both based in New York. We've been working in KPMG for a lot of years, both of us, and we were there back in 2018, the first tranche of tariffs was implemented. So we do have some expertise on it. And we really want to provide some guidance, and we hope this webinar is helpful to you. We want to make it participative, so please feel free to ask questions so that we can bring good discussion here. Next slide. So this would be the agenda for the webinar. First of all, we are going to give a little bit of background about customs and tariffs for maybe those participants that are not as familiar with customs. Then we are, Then we're gonna go through the presidential authority to impose tariffs and the different ways that the government can move forward with these tariffs. We will also cover the potential timelines because this might happen in the short, medium, and long term. So we will cover the different possibilities. And then we are going to give some guidance and tips on how to prepare for these upcoming changes. And then we will open the floor for questions. And hopefully, again, this is helpful for everyone attending. Next slide. Okay, next one. Okay, so President Trump's second administration is definitely going to be characterized by a high restrictive trade activity. Any country that has high trade excess with the United States is a potential target no matter whether it's an ally to the United States. Last November 26th, through the social media, Trump indicated his intention to impose tariffs, an additional 10% tariffs on goods coming from China origin goods, and then a 25% tariff on goods imported from Mexico and Canada. We don't know yet how he's going to do it. There are different ways. Irina is going to cover them in detail in the next section. Most likely he will use the International Emergency Economic Powers Act, but as I said, there are different ways. We also don't know if there are going to be exemptions, as it happened in 2018, that there were exclusions available for the importers. What we think is that most likely these tariffs will come into effect from day one, which is going to be January 2025. So it's important to be ready and prepared. On top of what we already discussed, the 10% tariff on China and the 25% on Mexico and Canada, there are other potential things. 60% targeted tariffs on China origin goods, higher tariffs for the European Union, around 25%, and then a 10% tariff globally on other jurisdictions, most favored nation changes pending congressional action, and finally 100% tariffs potentially on BRIC countries, which is Brazil, Russia, India, and China, because he doesn't want these countries to issue new currency. So this is also a potential thing that might happen. The policy towards other countries will be determined on those countries' stance towards China. So if those countries have restriction measures towards China, most likely will reduce the likelihood of tariffs with those countries. Next slide. All right, so this slide, we would like to go through the basics of customs because there is some confusion between customs duties and tariffs. Many times the tariffs are referred to as import taxes or duties, and that can get quite confusing. So we want to walk you through the process of the duty rate calculation and the tariff calculation. So when goods are imported into the United States, there are different factors to come into play to determine the duty rates. The first thing would be the HTS classification of the item, which is based on the technical characteristics and the use of that item. So a duty rate would be assigned. And also, it depends on the country of origin of that item. The country of origin is determined also based in different factors. Where is the manufacturing taking place, the raw materials, whether a substantial transformation takes place in another country. So these two factors combined, HTS classification and country of origin, will result on the duty rate. Once we have the duty rates, the tariff is something different, something separate. So for example, back in 2018, punitive tariffs were implemented. Let's use an example, Section 301, 25% tariffs on goods originating in China. So let's say a good has a 15% duty rate and then a 25% punitive tariff from China. So that would be 25% plus 15. That would be a 40%, which is applicable over the customs value. The customs value is the price paid or payable upon exportation of the goods to the United States, plus certain statutory additions that are listed on the US regulations. So if we add up the duty rates and then the tariff and we multiply by the customs value, then we get the tariffs due, and that's the total amount that the importer is going to have to pay for the importation of the item into the United States. Yeah, so this was the overview. So now I think we can jump onto the different ways that the tariffs can be imposed, and I'm gonna give the floor to Irina.
Thank you, Araceli, and good morning, everyone. So nice to see everyone today. A little bit of a background here. We don't want to spend too much time here, but we thought it was important to sort of lay out how this is possible, that some of these additional tariffs can happen. So in general, the U.S. Constitution gives Congress the power to impose and collect tariffs that Araceli just walked through. The Constitution gives the president authority to negotiate international agreements, but it assigns no specific power over international commerce and trade. Therefore, the president's authority to take tariff-related action must generally be statutory delegated by Congress. So, in all these discussions on the tariffs, it has not been mentioned what mechanisms will be used. So we sort of wanted to walk you through today the possible mechanisms. And, we sort of have laid out what the description of the section, the timeline, has it been used before, some of the duration. So, you could have this a bit as a takeaway. The point really is there's a lot of different mechanisms that can be used to achieve the additional tariff. So just to go through each one, Section 201, this allows the president to impose temporary import restrictions to protect U.S. industries from serious injury caused by increased imports. So this was used in the first administration, and it was used on washing machines and solar panels, and additional tariffs were levied on that. The second one is Section 232, and this is where really allows the president to adjust to appoint additional tariffs, and a lot of these allow additional tariffs or other import restrictions, such as quotas or other mechanisms. But for 232, it's really any items that threaten national defense or economic security. And this, you may remember, what in the first administration, there was an additional 25% tariff on steel and 10% on aluminum. And what this really was getting at is we were too dependent, or the thought was that we were too dependent on foreign steel and needed to get back a bit to the domestic industry. So that's Section 232. In terms of the timeline for both of these, they can take several months, but for 232, some of these investigations from Commerce or USTR can take upwards to a year to sort of review. Section 301, this is the one that obviously we're probably the most familiar with, because this is where the China tariffs were applied in 2018. So this authorizes the president to take action against foreign countries that violate trade agreements or engage in unfair trade practices. This ties into the trade deficit with China, which is around 279 billion, which is quite significant. So it can be implemented fairly quickly after the issuance of a U.S. trade rep investigative report. However, the investigation can take up to 12 months, not that it has to, but it can. And, this will go through in a minute how this was used in the first administration, but it really affected over 400 billion worth of goods with this additional tariff using Section 301. The next, so the first three we're thinking are pretty likely because they were used in the first administration. The fourth one is the one that Araceli mentioned, and this is the International Emergency Economic Powers Act. You may have heard of it as IEEPA for short. And this allows the president to regulate commerce after declaring a national emergency in response to any unusual and extraordinary threat. So and this can be implemented very, very quickly following a national emergency declaration. And this ties into what you probably are hearing about the fentanyl and drug epidemic, and also to the northern and southern border, for Canada and Mexico. This has been used before as an example for sanctions, and Trump did specify that he would use this in his first administration for tariffs against Mexico, but this was not used. That never really went into effect. The last two have rarely been used. Section 122 allows the president to impose temporary import surcharges to address balance of payment deficits. So this again ties into the deficit with China, and it's really to prevent imminent depreciation of the US dollar. And the last one, Section 338, allows the imposition of duties from countries that discriminate against US commerce. It's pretty broad in nature. It's really been used. So, these two could be used, could not, but we just wanted to sort of point out, hey, there's a lot of different mechanisms that are possible for the Trump administration to utilize, different timelines involved, some different oversight from different departments. But this is a real, ability to put these tariffs forward through these different mechanisms. If we could go to the next slide, we just wanted to show here, hey, will history repeat itself? Likely, yes, in some capacity. Obviously, we don't know which one yet, but this is just a little bit of a history and, and showing how the different statutes were used. Obviously, in 2018, 201 was used for additional duties on solar cells and modules and washing machines. And then the Section 301, which is, of course, what probably a lot of you are most concerned about, various different lists were put forth. A lot of the products had the 25% additional duty, some had 7.5%, and some had somewhere in between. And of course, then the 232, I just mentioned the steel and aluminum. During that time, in the first go around, it was very product specific. So it's really important to figure out the classification of your product, of course, as well as the origin. So since that was very product specific, exclusions were granted, and a lot of companies were able to get certain exclusions from some of these tariffs. Obviously, we'll still wait and see if that will be a possibility this go around. If we could go to the next slide. Some other things that we've sort of seen or are anticipating, we've already seen an increase in anti-dumping and countervailing duty investigation. So what anti-dumping is, if it's an import, if the government thinks that the goods are being sold at a lesser price in the US than in other markets, and sort of the goods are being dumped to sort of harm US industries, or countervailing duties when there's a subsidy being provided by a foreign government to lower some of the cost of those products into the US. We're seeing a lot of those investigations. A lot of them are China, some of them are other countries, and of course they're very product specific. The second, what we may see is now China has a most favored nation status, which allows the more preferential duty rate, not the tariffs we're talking about, but there is talk that may be taken away. The MFN status may be taken away, and different duty rates would be imposed for China. Could be for certain strategic items, and non-strategic items could have different duty rates. That's a possibility. The third one here is Section 321, and this is for informal entries of $800 or less. This applies to a lot of e-commerce shipments, which some of you likely have. So right now, if there's an import to one customer per day, you can benefit from the use of 321, not pay duty, not fill out a lot of the information that a formal entry requires. But even under the Biden administration, he sort of put into effect that this is something that they want to take away for China shipments. So that's still in progress, but we are anticipating that may be taken away for China shipments. And so more formal entries will have to be imposed. And, potential EU targeted countermeasures, which of course Araceli spoke about, the additional duties on the EU and certain products and how that will affect different supply chains. So those are just some items. There's a lot of other things. I think USMCA is being renegotiated, and a number of other things to anticipate. Or USMCA will be negotiated. So if we go to the next slide for potential timelines, this is laid out, and keep in mind, this is sort of, not set in stone. We still have to see what will be put into effect and when. But this is sort of, we laid out what a first 30 days can look like versus first year versus by the end of 2026. So we are thinking that, tariffs will be imposed, likely the IEPA or the national emergency through that mechanism, because that can be done pretty quickly. And, for China, there's a lot of talk of what the percentage will be. Obviously, the last of what he said was 10%. But previously, and I think Araceli had mentioned this, is he sort of quoted 60%. What we were hearing in the background was maybe it'd be 30 or 40%. But so this is still a wait and see what percentage will exactly be implemented. But what we have here is, if your products are already on the China 301 list, let's say they're currently at 25%, it may increase to 35% or 50%. We still don't know yet. And then, of course, we will still see additional 232 and 301 investigations for non-China trade as well. I think we're hearing a little bit that other countries will start coming up, in these investigations also. The first year, here we go, announcement of additional 301 investigations, some of the other remaining China imports, also EU imports, and we will be seeing increased enforcement of forced labor and supply chain traceability. Obviously, a lot of you probably familiar with the UFLPA and the requirements under that, but there has been a lot of enforcement already, but we do anticipate that will continue. And then by the end of 2026, obviously this isn't set in stone, but possibly the reimposition of suspended Boeing Airbus tariffs on EU products. You may remember during the first administration, a number of tariffs were put in place, anywhere from 15 to 25% on some EU products, whiskey, some luxury items, cheese, some other different products. So that's something that may be reconsidered. And then the USMCA renegotiation, right, which will likely happen in 2025, will likely have some domestic content changes and some tariff threats against Mexico. It's important to note that when we speak about the tariffs, let's say on Canada and Mexico, what we're hearing is, even if your product may be subject, you may qualify for USMCA, these additional tariffs may not be subject to that. So your goods, maybe for the duty rate, may qualify for USMCA, but you may still need to pay these additional punitive tariffs. That's still a wait and see as well. So that's a little bit of a timeline. Obviously, we may look at this and this may change 2 through 3 months from now. So I think the point is we're constantly just keeping abreast of everything going on and what we're hearing and the possibilities. And obviously, once the administration comes into force, we'll have a lot more clarity on some of these items. Now, we wanted to switch gears. If we could go to how to prepare. We wanted to switch gears here in terms of really, most importantly, right? What should you be doing right now? So first and foremost, I think it's really important, if you haven't already, to be looking at your trade data. And, in the US, you can look at it through ACE, Automation and Commercial Environment, from US Customs. Obviously, you can get customs broker data, internal data, but that's, I think, the best method in the US. Obviously, different methods globally as well. But really taking a look at what is the impact, just quick modeling out of, if these tariffs do go into effect, what's the worst case scenario of what you would need to pay in extra duties, because then you can sort of move on to, hey, what can I do to mitigate some of these tariffs? It's also important to just make sure that the origin of the goods is correct, if there's any complexity to it. The first go around, of course, I mentioned the classification is really important as well. because it was product specific. Right now, it's more across the board. So, that's still a wait and see, but it is important to always confirm your classification, but also most importantly, your origin in this case. And then mapping out some, where are your supply chain visibility mapping? Where are your inputs coming in? Are there other places to source from or manufacture other than, let's say, China origin goods as an example? Depending on the complexity, a lot of our clients the first time around, some of them were able to pivot in terms of where they're buying some of their materials or where they're doing their manufacturing, and some aren't. And we understand that that can be difficult, but that's actually just something to consider, right? Because you want to do an analysis of the landed duty cost of a lot of these items, and taking everything into account when you're looking at pricing from suppliers. Also renegotiating some of your contracts with suppliers. Who is going to, you may be the importer, right, in some cases, but are you going to take accountability for all the tariffs? Is it a shared cost? Is the negotiation something you're looking at from a negotiation perspective? So sort of all things to consider. And then, of course, moving on in tariff mitigation and recovery, and Araceli will go through in more specifics. But I think obviously when we look at how do we mitigate some of this, it's important to see what's available. So in the first administration, if there was an exclusion applicable or available, obviously that would be an easier method than implementing some of these other things, duty drawback for sale for export. So we always consider that. So we try to take a look at everything holistically, but also, what duty mitigation strategies can you use? Is there a free trade agreement for some of this? Obviously, it may apply just overall to your goods, not necessarily to the additional tariff. Are you looking at the value of your goods upon import? Maybe your product wasn't so dutiable before, so it wasn't as important, but are there any non-dutiable charges that you can eliminate from the price? And then, of course, can duty drawback apply if you import and subsequently export? Can you do first sale for export? We're going to go into each of these. I'm not going to spend a lot of time here, but really important to sort of plan out, even if you don't know, obviously you don't know yet. And a lot of people are in a wait and see scenario. But I think it's just important to take a look at your data, see what the potential impact is, and put in place some of the options that you may have if and when the duties do go in place. So I'm going to turn over to Araceli to walk through some of the tariff mitigation strategies.
Thank you, Irina. Yeah, so next slide. Okay, so as Irina said, we do have a number of mitigation strategies that can also result in duty savings for the companies. Being the first one, first sale for export, this is one of the most popular ones. We know a lot of US importers are using this. It can save millions of dollars a year, so it's widely used. And the way it works, as we touched base before, there are different methods of appraisement of the goods when they come into the United States as customs valuation. A transaction value would be the price paid or payable for the imported goods upon exportation to the United States. So generally, that's the invoice price, and generally that's the price of the last sale before importation into the United States. However, there are a lot of times when there are multi-tiered sales structures, and it is allowed to use the value of an earlier sale in the supply chain as long as certain requirements are met. So for instance, we put an example of a 3-tier structure. This could be 3-tier, but we've seen structures with 4, 5-tier. So in this case, we do have a manufacturer or a factory, a middleman, and a US importer. And we do have 2 sales involved: the first sale, invoice 1, and the second sale, invoice 2. So the first sale value would pretty much include the labor cost, the factory overhead and margin, and the raw materials. So that would make a value way lower than the second sale value, because as you can see in this example, the second sale value would include the first sale value plus a number of other costs, like the middleman markup, the foreign inland freight, IP rights, administrative cost. So the higher the markup is, for example, the higher the savings will be. What happens there? As I said, there are certain requirements that need to be met in order to be able to claim the first sale price. So first of all, what we do, because we need to make sure that this is going to be worth it and this is gonna result in savings for the companies, we do a feasibility analysis. We get the data that Irina mentioned before, and we look at the volumes, we look at the duty rates, and then we see the projected savings that this is gonna take. So in cases where the projected savings are high, then we would move forward with vetting the requirements. And if the requirements are met, then, like, for example, one of the requirements is clearly destined. The goods needs to be shipped directly from the factory to the United States. So we would vet that requirement. We also work with related entities. So if the middleman and the factory are related, we would need to vet the arm's length requirement to make sure that the price is at arm's length from a customs perspective. So once all of that is done, we present our findings, and the companies, if they are comfortable with it, they would start claiming the first sale price. And as I said, this may get the companies a significant number of savings, of duty savings. And this becomes very important if a 10, 25, or even 60% additional tariff is going to be imposed. Well, this is going to be a good way to mitigate that burden. Next slide. Okay, we also have the interconnection between transfer pricing and trade and customs. So transfer pricing and trade and customs are two different things. However, they are connected they are very connected. So lowering, and this, well, first of all, this is important for related entities. So if we have transactions between related companies, there is a transfer price between them. So playing with the transfer price in a proper way and lowering the transfer price might result in a lower customs value, and therefore there will be lower customs duties to pay. So this would be another savings strategy. However, we need to be careful, because lowering the transfer price would have another implications for tax purposes. So the transfer pricing team and the trade and customs team, they need to work hand in hand to make sure that the price is still going to be at arm's length for both transfer pricing purposes and trade and customs purposes. And for customs purposes, we have specific arm's length rules, which are different than those rules that might be applicable from an income tax or transfer pricing perspective. So yeah, lowering the transfer pricing price, it's a good option to get lower customs value and lower duties, but analysis beforehand definitely needs to be made to make sure everything is going to work properly for both TP and trade and customs. Next slide. Foreign trade zones, it's another methodology to get duty savings. So a foreign trade zone is considered outside of the US customs territory. So duty is not paid until the goods are withdrawn from the FTC. So there are a lot of times when the companies, they have like a distribution center for all North America that it's in the United States. This is just an example. So many times goods are imported into the United States, but not everything is going to stay in the United States. Maybe some goods are going to be shipped to other countries in Latin America, in Canada. So when the goods are transferred to an FTC, no duties are paid. And if the goods are subsequently exported to other countries, then no duties are paid at all. And also there is some inventory scrap or waste that it's normally not durable, and that will also result in savings. So that's the advantage for the goods that are going to be exported. But for the goods that are going to stay in the United States, there are several other advantages of an FTC. First of all, there is going to be a duty deferral because the goods are only gonna, like the duties are only gonna be due when the goods are entered for U.S. consumption into the U.S. customs territory. This is also gonna defer other fees that are due when importing, such as harbor maintenance fees or other. Also, with every entry declaration, there are generally merchandise processing fees and customs broker fees. FTC allows to do weekly entry. So meaning, and I'm gonna use another example here, if we have in a week 10 declarations, I'm gonna have to pay, if I am not importing the goods through an FTC, I'm gonna have to pay the merchandise processing fee and the customs broker fee for each one of those 10 declarations. However, if I have an FTC, I can bundle those 10 declarations in a weekly entry, and that weekly entry is only gonna have one customs broker fee and one MTF, so that will definitely remove costs. And on the other hand, the first year that the FTC is set up, there will be a cash flow enhancement, and it will also make the supply chain more efficient. There will be like an improved security control, especially for those companies that are CTPAT, and the clearing through customs is gonna be faster. So yeah, this is a few of the benefits. Of course, with this one, we also do a feasibility analysis first, because an FTC implies cost, administrative work, and inventory system. So we would get the data and we would make sure first that this is worth it. But if it is, it will also imply big savings. Next slide. Duty drawback is another program by U.S. Customs, U.S. CBP. So this is a little bit different. The FTC, if you put them in the FTC and export, no duties were due. In this case, the duties are paid when importing the goods into the United States. However, if they are exported, drawback will provide for 99% refund of duties, taxes, and fees that were paid upon importation of the goods into the United States. And companies can go 5 years backwards and recoup all of those duties. There are different types of duty drawback. There are duty drawback for unused merchandise, for manufacturing, and also for rejected merchandise. There are different types of drawback based on the type of goods and other factors. So for those companies claiming duty drawback, a preliminary analysis should be also made to determine which type of drawback is more suitable for that company based on their import profile, import-export profile. So that's something that needs to be done. And then the drawback generally is filed by the exporter of record, but with the proper authorizations and documentation, the importer of the goods, because sometimes the importer and the exporter are the same legal entity, but sometimes the importer is entity A and the exporter might be entity B. But as I said, with proper authorizations, a company which is not the exporter, which might be the importer, the producer, or even a third party, they might file the duty drawback claims. And it is key for duty drawback purposes to have everything documented and to have good record retention policies, because this includes import documentation, export documentation, incoming and outgoing inventory. So record keeping is like a key point for duty drawback. But again, this is also a very good savings strategy for importers. Next slide. Yeah, and finally, I mean, there are a number of other things that could be done. We just wanted to focus on the most important ones or the most popular that we see that companies are using. But just to cite a few examples here, cost unbundling could be one. So if I said before, transaction value is generally the invoice price, but from certain invoices, we can itemize cost, and there are some non-durable charges that can be removed from the invoice cost, and that would reduce the invoice price and therefore reduce the customs value and the duties. So that's another strategy. Shifting sourcing, and that kind of ties into the planning that Irina was talking about before, either to countries which are not impacted by the tariffs, or either to countries that have a free trade agreement that it's not foreseen that they are going to disappear in the short term. So maybe renegotiate contracts and find suppliers in different countries could be another strategy. And as we said before, transfer pricing planning to lower the customs duty cost. That would be another thing. But as I said, there are much more strategies, and we are happy to discuss. This goes on a case-by-case basis, looking at the company's import profile, like one of them might be more appropriate than other. So we are happy to have one-on-one discussions with companies if this is something that might be of interest.